Did you know that the Bank of Canada has just cut its overnight rate to 2.25%? A move many in the real estate industry believe will ignite a flurry of deals? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a recent report by CoStar, the Bank of Canada has lowered its target overnight rate by a quarter percentage point, bringing it to 2.25%. This marks the second rate cut by the central bank in less than 2 months. The decision comes amid ongoing economic challenges and an inflation rate that is expected to hover around the 2% target. The Canadian economy, as described by the bank, is undergoing a difficult transition due to structural damage from a trade conflict with the United States, which has reduced economic capacity and increased costs. The Governing Council of the Bank of Canada believes that the current policy rate is appropriate to maintain inflation close to 2% while assisting the economy through this structural adjustment. Commercial real estate leaders have welcomed this decision. Mark Feeder, president of Avison Young Canada, expressed optimism, stating that lower interest rates will stimulate the market and attract investors who have been hesitant, as well as boost confidence among those already active. Residential brokers share this sentiment. Don Kotick, president of RE/MAX Canada, mentioned that the rate cut could enhance consumer confidence across Canada's housing market, potentially encouraging more buyers to enter the market. While inflation remains a concern, the cut signals cautious optimism for the sector. Interestingly, the U.S. Federal Reserve also reduced its benchmark lending rate by a quarter percentage point recently, highlighting a broader trend of rate cuts in North America. This has been seen as a move to support growth amid various economic challenges. Marc Lefrançois, a real estate broker, noted that this rate cut reflects the central bank's commitment to stimulating activity. Despite a rise in Canada's consumer price index to 2.4% in September, the Bank of Canada has prioritized supporting growth. For the real estate sector, the lower borrowing costs could intensify pressure on a market already struggling to meet strong demand. The Bank of Canada acknowledges that underlying inflation remains around 2.5%, but expects pressures to ease. Some analysts suggest the bank might tolerate inflation closer to 3% due to growth risks. This flexibility is seen as necessary given the economic pressures from trade tensions and other factors. The housing market continues to face pressure, with builders dealing with high costs and tighter lending conditions. The rate cut comes alongside escalating trade tensions, particularly following new tariffs announced by the U.S. on Canadian exports like steel and lumber. Canada's economy contracted by 1.6% in the second quarter, driven by a decline in exports and weak business investment. Despite healthy household spending, trade actions by the United States and related uncertainties are significantly impacting sectors like autos, steel, aluminum, and lumber. The Bank of Canada forecasts GDP growth of 1.2% in 2025, 1.1% in 2026, and 1.6% in 2027. Workforce market conditions remain soft, with unemployment at 7.1% and wage growth slowing. Employment gains in September followed significant losses in previous months, with hiring weak across trade-sensitive sectors. This rate cut might just be the stimulus needed to revitalize the market and boost investor confidence. Artificial intelligence is making significant waves in Canadian commercial real estate, according to a recent Deloitte report. The report highlights how owners and operators who implement generative AI and agentic AI are setting themselves up to outperform in the market. This comes at a time when tariffs and tight tenant budgets are adding pressure to Canada's commercial real estate sector, leading to higher operating costs and vacancy rates. Interestingly, the report surveyed 100 commercial real estate owners and 100 tenants to understand the current market dynamics. Smaller real estate owners have felt the pinch more acutely due to supply chain disruptions, whereas larger owners have experienced fluctuations in asset valuations and capitalization rates. Tenants, on the other hand, are responding to tariff pressures by tightening their budgets, scaling back expansion plans, and prioritizing lease flexibility. The demands from tenants are clear. 74% are seeking rental concessions. 65% want flexible lease terms, and a significant number are pushing for subscription-based services and amenities. Additionally, 73% are looking for waste management upgrades and 72% for accessibility renovations, while 69% are calling for energy efficiency upgrades. Technology and AI are becoming critical tools for commercial real estate owners to meet these demands and future-proof their assets. The industry is no longer questioning if AI is important, but rather how quickly it can be deployed to protect value, create new revenue streams, and build resilience. Saurabh Mahajan, real estate strategy, innovation, and insights leader at Deloitte, emphasizes this shift, noting that AI is being treated as a value driver, not just a cost. A practical example from the Deloitte report shows how a retailer deployed an autonomous HVAC optimization platform across over 600 stores, resulting in approximately $1.38 million in electricity cost savings and an 8 million kilowatt reduction in annual electricity usage. This initiative also led to a valuation impact of around $24.46 million, driven by cost savings and net operating income uplift. Quadreal Property Group is another example, leveraging an AI-driven renter, CRM, and virtual leasing agent to automate lead handling and improve tour-to-lease conversions by 33%. This advancement has helped shorten vacancy periods and increase effective rent capture. Commercial real estate owners are encouraged to link every AI investment to a financial key performance indicator, like goals for net operating income uplift or operating expense reduction. Collaborating with AI integrators and transformation partners can further enhance these efforts. Deploying generative AI and agentic AI to automate key real estate processes is another recommendation from Deloitte. Tasks such as optimizing HVAC systems, analyzing complex data, and automating lease management are being streamlined through AI. Owners and operators can now automate tasks like adjusting HVAC set points and querying buildings with natural language to identify performance variances in real time. Moreover, integrating AI with enterprise resource planning systems is crucial for improving operational efficiency and productivity. By modernizing ERP and integrating with AI, owners can automate data entry, enhance intelligent reporting, and personalize tenant communications. Real estate ERP solutions are embedding AI capabilities to assist with tasks such as tenant follow-ups and invoice approvals. To truly transform real estate data into dollars, Deloitte suggests building a centralized data lake and creating an AI governance framework. This will help overcome data quality and availability challenges. Running AI pilots across different processes is also recommended to demonstrate AI capabilities and gather stakeholder feedback for improvement. Now, let's delve into a situation that's causing quite a stir in Ontario's rental market. Tenants in a midtown low-rise building in the Yonge Clare Avenue area of Toronto have been facing a rent increase that far exceeds the province's standard allowable increase. According to a report by CBC, about 40 tenants at Mallory Gardens were informed in September that their rents would rise by approximately 5% in 2026, more than twice the province's allowable increase of 2.5% this year. Wendy Morrow, a tenant organizer with the Federation of Metro Tenants Associations, revealed that the landlord, Westbury Rental Residences, applied for an above-guideline rent increase, or AGI, citing building improvements over the past 18 months. However, many tenants reported that promised enhancements didn't materialize, with some services even being removed. Despite Westbury's claim of adding a new boiler and hot water system, tenants complained of inconsistent hot water and limited access to the underground parking garage, which was supposedly restored as part of the improvements. Tori Woolcott, a tenant at the building, expressed frustration over the intermittent hot water, stating, "If I'm going to give my kid a bath, it's a coin flip whether it's going to be warm or cold water that comes out." The tenants took their concerns to the landlord and tenant board earlier this month and agreed to mediation. However, they now regret this decision, feeling rushed and pressured to accept the terms. They were told that most of the landlord's rent increase request would be granted, leading to a retroactive rent hike backdated to January 2024. Keen Sue, another tenant, shared that they felt coerced and bullied during the mediation process, with little room for appeal. The landlord's initial AGI request of 4.3% was slightly reduced to 4.25%, but this, combined with the baseline 2.5% rent increase, results in a total hike exceeding 5%, which is a significant burden for the tenants. The landlord maintains that over $300,000 has been spent on upgrades and repairs since 2022, including boiler replacements and brickwork maintenance. However, tenants like Mary Beth Ferguson have seen their parking situations deteriorate, with spaces being moved or taken away. Sean O'Connor, a paralegal specializing in landlord-tenant cases, advises tenants to seek legal representation before attending LTB hearings, as these processes can be complex. Wendy Morrow also suggests that tenants thoroughly check the landlord's claims and supporting documents to ensure accuracy. This situation highlights the growing issue of AGIs across the city, with many tenants facing similar challenges. It underscores the importance of being prepared and informed when navigating landlord-tenant disputes. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.